Right, hi, I'm Colin Mason. I'm Professor of Entrepreneurship at the Hunter Centre for Entrepreneurship. So I'm going to talk today about how you would finance a business. So you've got an idea for a business. You need resources to put your idea into practice. What should you do? The reaction of most people would be to say, right, I need to go down to my bank and ask my bank manager for money. What I'm going to suggest is that should not be your first step. Why not? Well, banks are in the business of lending money. They want their money back. But if they lend money to you, they're going to want some kind of security or collateral, some asset that they can take ownership of should you not be able to pay back your loan. So they'll look at you as a new business and say, first of all, well, where's the track record? How can we judge how likely you are to be able to pay back our loan? How can we judge what the risks are? Secondly, they'll say, well, okay, where's your security? What collateral can you offer us as a guarantee if we lend you money? And thirdly, since a bank loan has to be repaid, they're going to want to say, well, where's the revenue stream? How can you demonstrate that you'll generate enough revenue to pay back the loan? And of course, by definition, a new business doesn't have any revenue at the moment. So for all these reasons, there's a very high probability that if you go down to your bank manager with a business plan, they're very likely to say, no, we're not going to lend to you. And indeed, this is the reality. Most startups do not get funded by banks at the startup phase. A guy from Harvard, Amar Bide, he wrote a really very in-depth book on the origin and evolution of new businesses. And here's some key findings from a very detailed survey of new businesses in the USA. Most startups don't have the assets that an objective investor would consider to be valuable. In other words, looking at that from the outside, most investors would view a new business and think they're highly risky and aren't going to be successful. And clearly that would discourage them from wanting to commit any money. Another quote from Bide: in many startups, the founders have little to offer the investors besides their hopes and dreams. The entrepreneurs believe that they can somehow make a profit, but the investors do not. Again, it's all about perceptions. An entrepreneur by definition has got to be optimistic, believe that their product or service is going to find customers. The investor, looking on the sidelines, can take a more objective view, and in most cases we have this mismatch between the entrepreneur's very optimistic view of their likely success and the investor's rather pessimistic view. So this really means, and a great quote from Bide, the biggest challenge for entrepreneurs is not raising money, but actually having the wits and hustle to do without it. Most businesses don't start with outside money. Nevertheless, many of them still manage to get started. So, where do they get their money from? Where do startups get their money from? First of all, it's from what's often called the 3 Fs, or sometimes the 4 Fs. The founder will be expected to put some money in themselves, and then they'll go around their family to look for some funding, and their friends as well. And perhaps the 4th F might be fools. Secondly, there might be some soft money. In other words, particularly in less developed regions, economic development agencies, in an effort to encourage business startups, will make funding available. Grants, perhaps, where you don't have to repay the money. Soft loans, where you don't have to provide security for the loan, and indeed where there's perhaps a low interest rate. In Scotland, we have the Prince's Scottish Youth Business Trust that is an excellent source of soft loans for emerging businesses started by young people. And anyone thinking of starting a business or in the early stages of running a business should certainly go to the PSYBT. And then last of all is something called bootstrapping, which is defined as creative techniques for either avoiding the use of financing or minimizing the need for financing. After all, why do businesses need money? They need money to buy resources. Well, if you can get resources without paying for them, or if you can get the resources at below market rate, you either need no money or less money. So what sorts of strategies are we thinking about? very common one is using the credit card. If you're clever with your credit card, you can pay for your supplies, and you've got about 40 days before you have to pay your credit card bill. And if you can get your customers to pay you within these 40 days, that covers the working capital cycle. Barter, possibly. You may have some assets that are valuable to somebody else, maybe a list of customers, or perhaps they may have assets that are valuable to you. Getting your customers to pay up front would be another bootstrapping strategy. Of course, using second-hand equipment, working from home, or indeed working from Starbucks, saves you on rent. If you're starting your business part-time and you're still in employment or still a student, you can use the facilities of your employer or the university to get going, and so on and so on. There are many different kinds of bootstrapping strategies. And that's the reality. As the late Geoffrey Timmons, who wrote one of the first books on new venture creation, said, bootstrapping is a way of life for entrepreneurial companies. That's how most companies get started. Even great companies get started this way. Companies that are multi-million pound companies today started with bootstrapping. There's an American magazine aimed at growing businesses called Inc. magazine, and every couple of years they run a special issue with a cover page, great companies started with less than £10,000. So even if you're bootstrapping and putting in very little money, that doesn't preclude you from actually growing a significant business down the line. So maybe just something to think about in terms of bootstrapping. What resources do you have that might be used to help your business to grow? What resources can you access without paying for them? To be an effective bootstrapper really involves exploiting your social capital. In other words, who you know. And this is where who you know actually is in many cases more important than what you know. So your social networks are of two kinds. Personal, your family and your friends. Who can you access through them? Your neighbours. Perhaps your neighbour runs a business and they might have a bit of floor space available that you can use for your business. Another part of your social capital network are your business and professional contacts. They too can be valuable. And the literature talks about having strong networks and weak networks. Most people have a relatively small number of very strong networks. These are your very close friends. And lots of weak networks or weak ties. And it's very often your weak ties, the people you kind of engage with periodically or occasionally, they're the ones that might offer access to resources that are important for your business. In the Hunter Centre for Entrepreneurship, as those of you who do of course know, we run something called the Value Challenge, where we set an assignment whereby students are allowed to invest up to £20, and they've got to turn that investment into financial value by undertaking some kind of entrepreneurial activity. And what we find when we run that project is that virtually every group, whether they realise it or not, is engaging in bootstrapping. That's how they turn their £20 into £50, £100, £200, in one case £700 of value. Some companies, some of the students run events, new bands nights. They're able to negotiate free venue space. One group this year, one of them is the group worked in a radio station, and their project was to make a CD, so she was able to get the group access to free recording space. Other groups were able to access specialist software through friends and family. Another group were able to use their contacts to distribute their products for free. So here's people just like you doing an assignment, actually able to bootstrap. And students said in their learning reflections, it's remarkable just how far you can go just through bootstrapping. These sources, the 3 Fs, the soft money, the bootstrapping, should be able to get your business off the ground. As the Americans say, it will give you traction. In other words, it allows you to get to the point where you have a product or service that you can demonstrate actually works. You can also demonstrate that there is demand by achieving some initial sales and revenue. And it also gets you to the point where you can iterate your product or service in response to initial customer feedback. In other words, tweak it so that you iron out the bugs, or you focus it a bit more on what the customer actually wants. So it's really only at this point where you actually begin to think about looking to external sources to fund the next phase of the business, the growth phase. First question to ask yourself is actually, do I need to raise money? Because you've got to remember, money has its costs. First of all, there are financial costs. Getting money involves fees. If you're borrowing, you've got to pay interest rates. If you're raising equity finance, at least in theory, there might be dividend payments, a share of the profits that you'll pay to your investors. But there's also huge non-financial costs of raising external money. There's simply the time involved in finding investors, negotiating with investors, presenting to investors. And of course, if anyone puts money into your business, whether it's a banker or an investor, they will want a say in the business. So immediately you lose some control. You'll be limited in terms of what actions you can take without getting their approval. They might restrict some of the decisions that you can make. So you need to think twice about actually whether you want to go for external funding. Some businesses are able to fund their growth simply through revenue. And it's a cliche, but a very important one, that the best kind of money is the money that comes from your customer. In other words, generating sales revenue. That's the best kind of money on which to grow a business. Not every business is able to grow on the basis just of sales revenue. It needs to be a business which can quickly become profitable. It needs to be a business where there's little or no upfront investment required. It's a business where there's good profit margins. In these circumstances, perhaps all you need in terms of external finance is bank funding just to fund working capital, to fund the cycle between when you have to spend money on your suppliers and when you get the money back from the customers. But some businesses will need to invest to grow the customer base, to reach profitability. So in other words, these businesses will actually need some kind of financial investment upfront to grow the business. And this investment is bigger than the revenue that they can expect in the foreseeable future. So these will be businesses that need to do some research and development to develop and test a product. So technology businesses then will have a period of time where they're actually developing the product before they can actually do sales. How will this pre-revenue period be funded? Maybe that they need to hire workforce to make the product or deliver the service. And again, their salary bills may well be substantially larger than the initial revenue. They may need infrastructure to scale up the business, factories or service outlets or whatever. And this phase in a business whereby your investment needs exceed your revenue is often called the valley of death. And here's a couple of diagrams that illustrate this valley of death. And this is a point that many growing businesses, particularly technology businesses, will actually face. They have a period where they need to invest before they can actually generate revenue. And that's a real funding challenge. This valley of death can't be funded by the banks for the reasons we mentioned earlier, because there's no cash flow, there's no revenues to service a bank loan. A bank's not going to say, okay, we're happy to wait for 3 years until you generate customers and revenue. Banks just don't work that way. Funding the valley of death is high risk and therefore requires equity finance. In other words, it needs an investor who's prepared to share the financial risk with the entrepreneur, put their own money at risk to losing it if the business fails, but equally sharing in the success if the business is successful. That's really the definition of an equity investor. But of course, this means that the entrepreneur is selling a minority stake in their business in exchange for money. And by no means every entrepreneur is comfortable with the idea of not owning 100% of their business. But in many cases, it's a trade-off you have to make. Do you want to own 100% of a small business, or perhaps 60 or 70% of a much bigger business. It depends on your ambitions. Next question then is, well, where do you look for equity capital? Well, again, in terms of a bit of jargon, this kind of capital often goes under the heading of venture capital. And there's really two sources of venture capital. There are out there professional venture capital funds. These are basically professional managers of other people's money. They raise investment funds from pension funds, from insurance companies, from endowment trusts and so on. And invest that money in promising companies. A good example locally is Scottish Equity Partners, who have their head office in Blythewood Square. There's a trade association called the British Venture Capital Association. You can go to their website and you'll see a list of all their members, a couple of hundred members. And indeed, venture capital is an international phenomenon. Despite its profile, very, very few entrepreneurs will actually be able to raise money from venture capital funds, for a whole variety of reasons. First, venture capital funds like to invest their money in big amounts. So unless you're looking for kind of £1 million or more, you won't get money from venture capital. And this is just because of the economics of investing. It's not economic for venture capital funds to make what they would see as small investments. Secondly, venture capital funds are highly selective in the types of businesses that they invest in. They're looking to invest in businesses that have the potential to generate high returns, indeed extraordinary returns. The fact of life as a venture capitalist is that for every 10 investments you make, 2 might be outstanding successes, another 3 you'll lose all your money, and the remainder will make a very modest return, or you might just get your money back. So these 2 outstanding successes have both got to generate the return you're looking for, plus offset all the other investments that don't make any money. So venture capital are really looking to invest in businesses that they think will make really very high returns. So that really means that these companies have got to have global potential. Venture capital funds are looking to invest in companies that have got the potential to become global companies. They also don't invest in startups. They only look to invest in companies with some evidence of market traction. Indeed, over the years, venture capital funds have started investing later and later in company development. And the reality is that in a country like the UK, venture capital funds only are investing in a couple of hundred companies every year. So the odds on matching the requirements of venture capitalists and being in one of these couple of hundred is extremely remote.